For a closer look at those PPI numbers we just got, the implications for the markets, for the Feds, we want to bring in former St. Louis Fed President James Bullard. He is now the dean of the Mitch Daniels School of Business at Purdue University. And Dean Bullard, thank you for being with us. You know, it's not all that often that Steve Leisman and Rick Santelli see things the exact same way, but that's pretty much what happened with the PPI numbers that we just got. They both looked at it and said, really, warm report no matter which way you look at it, and both of them came to the same conclusion that any Fed official, no matter who you are appointed by, is going to have a hard time cutting interest rates as you look at numbers like that. Do you agree as well?
Yeah, well, why not make it a trifecta? I agree with Rick and Steve on this. I think this was a hot report. It's just one report, but you know, a disturbing trend toward somewhat higher inflation, where the committee has been arguing that if you're patient enough and you look past one-time effects, that you'd eventually get back to 2% inflation. But now you've got this report and core PCE inflation, which is the committee's favorite measure on an annual basis, running over 3%. So I think it's a moment where the committee has to reaffirm that they really do want to get inflation back to 2%, and they're going to pursue a policy to do that.
Add to that the idea that these numbers are coming before you even really take into effect the impact of higher oil prices, what we've seen just in the last couple of weeks, 18 days, I guess I should say, since the bombs began falling in Iran. How does that change the situation? What would the discussion at the table today at the FOMC be, do you think?
There'll be a lot of discussion, but ultimately it'll be a wait and see stance because I think in central banking you wouldn't want to commit to making a move today for sure, but also even hinting about future moves when you really don't know the outcome of this situation. I think so far markets have been, you know, as you guys have been reporting, you know, been pretty complacent about this. They think that the conflict will be resolved, and they think that ultimately there won't be too much damage to the global economy. You do have the strait, you know, bottled up here, and it's not that easy to see how that's going to resolve. But for now, I think they're going to want to wait and see, not commit to anything going forward, and then they can take the appropriate moves in the future.
You point out that the market's been fairly complacent to this point. I'd like to get the view of a former Fed president in St. Louis who's pretty familiar with farming, with commodities markets. Obviously, you're still there in the middle of it in Indiana at Purdue. What is the potential impact for all of the people you would be hearing from if you were still St. Louis Fed chief?
Yeah, agriculture does have the fertilizer issue, and you know, as far as I can tell, they're, you know, scrambling for alternative sources and maybe a few things that can be done. But you do have planting season coming up here, so that's you know, certainly a major topic of discussion. It's a big industry, and it would, you know, could affect farm income this year, and could be a major factor. So that's certainly something that bears watching going forward.
Jim, what do you think about the economy overall? Most people think that we were in a pretty good place, at least at the beginning of this year. Do you agree with that? And how do you think we are faring right now?
I think the economy's in fairly good condition, and I think we're in good shape for 2026 as a whole. Obviously, this is a big wild card right now, but still, I would say based on what we know today, the U.S. is in great shape. On the labor market, the committee has already reacted, I think, preemptively to labor market weakness, and I've been interpreting the, you know, very low non-farm payrolls run rate as a consequence of the new, tougher immigration policy that we have. Mm-hmm. So I think adjusting for the immigration policy, I actually think the labor market is fine. Initial claims are low. The unemployment rate is near the natural rate. So I think labor market is fine, and they've already preemptively adjusted for that. And then on the inflation side, that's not looking so good. And so I think they're going to have to focus a little more on inflation through the end of the year. I'd like, you should be able to project that inflation is going to be back at 2% by the end of 2027, but that isn't happening right now. Markets are saying you're still going to be in the high 2% range at that point. And that would be quite a few years in a row missing your inflation target to the high side. So I think committee probably has to get a little tougher on inflation at this juncture.
You say the job market's fine because of the immigration changes and factoring that in, but you do have a lot of people that are awfully worried about the impact of AI. Block laying off 40% of its employees. Maybe that's just one company, but that was a large number, 10,000 employees, letting go 4,000 of them. And then you have predictions like 30% of college graduates are going to have trouble or won't be able to find a job when they come out because of AI as well. Do you not subscribe to those concerns?
Yeah, we actually put an AI requirement here at the Daniel School, but I think the graduates, especially at a technical university like this one, they're going to be in demand because they're the ones that are going to know something about AI and the applications. A lot of times you get businesses maybe have an older workforce and they're not as adept with the latest technology and stuff. So I think the younger people, if they get the right major and the right training, will be in great shape. I think as far as AI taking jobs, very rapidly on the Block decision, I think there's been some pushback against that. I think some people think Block, had too many employees and they use this as a reason, to cut back. But, it's going to be a great technology. A lot of great things are going to happen, but it's going to be enhancing for workers. You're going to enhance productivity and hopefully get a productivity boom in the U.S. I don't see that as a dangerous thing. I see that as a good thing, and there will be new jobs created that you can't think of right now because we don't understand the technology well enough. But all of that will happen because that's exactly the way it's happened in the past with new technology.